Good morning, everyone. Welcome to this morning's webinar. I'm James Kipping, tax partner at MHA. I'm joined this morning by my fellow tax partner, Tony Metcalf, and Professor Joe Nellis. Joe's a professor of global economy at Cranfield University and is our main speaker today. Many of you will, of course, have attended the excellent presentations he's given to us in the past, so he needs little in the way of introduction. It's well known, of course, that in the wake of the COVID-19 pandemic, the ongoing situation in Ukraine, the energy and cost of living issues, the UK is, of course, facing a tough time. Many households will be confronted with significant falls in their real incomes and living standards. Joe will provide an economic update from a UK and a global perspective in light of last week's budget. And as I say, that will be the main part of today's talk, probably the first 45 minutes or so. Tony and I then have the unenviable task of following Joe when we'll discuss the main personal and business tax announcements from last week's budget. We're hoping to be done in 15 minutes or so to leave around 25 minutes for questions at the end. In that regard, please use the Q&A function to ask your questions, and we'll get through as many as possible at the end. And on that note, I will hand over to Joe to get us started.
Many thanks, James, and good morning, everybody. I was just commenting earlier on the first slide, which shows the green shoots of recovery. Well, the green shoots of spring, I suppose. I'm not sure if recovery is in the air yet. There's a lot to talk about. So without further ado, let me go straight into this. And in advance, I want to make an apology. There's so much information available at the moment that I may try to pack in too much. You may recall in last September's mini budget, there wasn't an OBR report. Well, in this budget, there was an OBR report which ran to 166 pages. So there's a lot of content, but don't panic. I'm going to focus on the main elements of that. I'm going to start, as James said, with a very brief run through the global economic outlook. And I've just picked a couple of the latest reports coming from the OECD just to highlight the global situation. This particular slide, you'll notice something very important. In 2023 and 2024, if you go to the bottom of this slide, you will notice the UK is, well, this year will be at the bottom, apart from Russia, of course. And then next year, the OECD is predicting growth of 0.9%. Again, way below many other countries. Now, that doesn't mean that they're going to be correct, although these particular views from the OECD do coincide very closely with the OBR, the independent view here in the UK. So we are going to face a difficult couple of years ahead of us, but I'll come back to the UK later, of course. By the way, all of these slides will be made available to you, so you can digest them all later at your leisure. Now, in terms of global inflation, there is a very clear picture emerging across the world. Inflation is tracking down. There are a couple of exceptions, but in terms of the vast majority of countries, we're going to see some significant falls in inflation later this year into next year. Of course, you've heard about the UK inflation this morning at 10.4%, which I will comment, of course, when I come to that. But just to repeat, inflation is going to track down. Remember, if prices double and then they stay at that level, inflation goes back to zero. So this is a statistical fact. But there are, of course, factors that are causing this. Supply chains are being unlocked. The effect of the war in Ukraine, we hope we don't see further implications for energy prices, but that is to be seen. So what we're expecting across the globe, inflation to start tracking back towards target. You'll see the blue column show the 2023 figures as we go throughout the year. And then 2024, the little white diamonds in each of these. And you'll notice, again, the fall. So you see the UK figure from about below 7% by the middle of the year towards 3% next year. But I did say earlier, there are a couple of exceptions, and I just thought I'd highlight these. If we think inflation in the UK is a problem, well, look what it's like in Argentina. At the moment, the figure in Argentina is over 100%, although it's going to track down below 90% this year. Goodness me. And then Turkey is also has a major inflation problem, and it isn't going to fall much in 2024. That's just to make you feel a little bit happier about the UK situation, rather extreme in terms of Argentina and Turkey. But again, the message is clear. Across the world, inflation is going to be tracking down throughout 2023 into 2024, subject to unforeseen events, of course. There is a problem, however, that we're going to come back to in the context of the UK, and the budget linked some of the measures to this as well. There's a decline in global productivity growth. You'll notice the green arrows show the average over the 10-year period from 1990 to 1999 for labour productivity. Productivity is what drives economies. That's critical to appreciate. And if you look at the red columns, you'll notice something from 2023 to 2013 to 2022. You'll notice that all of the red bars are smaller than the green bars. And this is an issue across the world. But of course, we're particularly concerned about the UK economy, where productivity has fallen sharply from what we might call the good years to now what is the bad years. And if you look to the far right, you'll notice China, by the way, is also facing a slowdown in productivity, which is not a big surprise. It's been motoring so fast for the last few decades that a slight slowdown is not unexpected. But China is forging ahead relative to the rest of the world. I'm sure we'll come back to that because productivity is so critical, and we need to get that increased here in the UK and elsewhere. So that's a nice transition into the UK economy. And let me just update where we are. I put an exclamation mark at the end of this comment. I wish it was different. We are facing a very challenging outlook for the next few years. And I think this is going to continue for several years. The conditions for growth are not strong. The outlook has improved slightly in recent months, absolutely. Post the mini budget last year, there's been a slight improvement, but I don't want to exaggerate that. I would like to exaggerate it, by the way. And certainly in last week's budget, there was a degree of, shall we say, exaggeration, but that's not surprising. If I were the Chancellor, I'd want to make you all feel a little bit more optimistic about the future, of course. But here's the words from the Chancellor last week, which did surprise me a little bit as an economist. His words were, the UK will avoid a technical recession in 2023. The word technical is an economic term. Technical strictly means two consecutive quarters of falling GDP. And we are likely to avoid that. But we could have a fall in Q1, we could flatline in Q2, and then have another fall in Q3, but we would have avoided a technical recession. So he was playing, I think, with the words with a little bit of mischief to some extent, but understandable, by the way. It is going to be a tough year. To avoid a technical recession is not really cause for celebration, especially when the forecast is still for an overall fall of 0.2% throughout the year. But nevertheless, let's not be too negative. However, it is now almost unavoidable that we will see zero economic growth over the entire post-pandemic period, and perhaps more importantly for the government, over the entire 5-year parliament since 2019. It is now almost unavoidable. And in fact, I would say it is certain we're going to see zero growth over the entire parliament. Now, that hasn't happened for decades. In my lifetime, it's never happened. And so it is a particularly important point to note. We are going to flatline over this period. We are not going to see a boom, by the way, between now and the next election. Nobody is predicting that. So this is inevitable. And the latest forecasts, the latest data, and then have the latest forecast in a moment. Up until the fourth quarter of last year, you'll notice we did avoid a technical recession. We had a fall of 0.2% in the third quarter, and then we flatlined in the fourth quarter, so we avoided a technical recession. Nevertheless, it doesn't feel good. If I then take the forecast, and these are directly from the OBR, and just to remind everybody, the OBR is an independent organization, so these are not driven by the Treasury. These are an independent assessment of the Treasury's figures. A busy slide. I'm going to use these dates several times. You'll notice last March that the green line had a more upbeat outlook up until 2027. And then we had the November forecast, which was more downbeat because that was post the mini budget in September. And now we have the latest forecast produced by the OBR just last week, the March 2023 forecast. And you'll see the slight improvement, but just look very carefully because between 2019, the pre-pandemic, the whole year of the Parliament, the 5-year Parliament, 2019, until the very last date possible, early 2024, you'll notice, by the way, there's zero, if you look at those two red lines, zero growth in that 5-year period. And these are the OBR's own figures. Important to note that. Now, the growth after that that's forecast is very gradual. This is really quite slow growth, but nevertheless, any growth will be very welcome, of course. The other point that I need to pick up, and the OBR have pointed this out, business investment has been flat since Brexit. I'm not going to go back over the Brexit issues, by the way. This is simply reporting what the OBR have stated. Back in, you'll see, in March 2016, they had a forecast then, which is the red dotted line. They're using a trend line here. Business investment was expected to rise steadily. You'll notice that very clearly. But since the EU referendum and right up until the present day, if you go to the far right of this slide, you'll notice we're back to 0%. In other words, we've had no increase in overall investment in that period since 2016, which is disappointing to say the least. And a phrase that I use frequently, and you've heard me say it before, investment is the engine of growth. We desperately need to get investment going much more strongly in this country, because investment drives productivity and productivity creates growth. Very important to appreciate that. It's been a disappointing 7-year period so far. And these are the forecasts from the OBR. So this is taking a longer time period and just looking ahead to 2028. Again, look very carefully. You see the November forecast, the yellow line, and then you see the March 2023 pre-measures forecast, and then we see the latest figures published during the time of the budget, the March 2023 forecast, the blue line, and you'll notice there's a slight improvement. But then if you look carefully, if you look towards the 2026, 2027, you'll see a downturn again based on the OBR's own forecast. So the budget measures are going to improve investment slightly for the next couple of years, but then the effect of those is predicted to then diminish again. So the government's going to have to come back to this to stimulate more investment, well, hopefully as soon as possible. So what has happened? Well, maybe we can discuss that later. My own personal view is there has been so much uncertainty in recent years. Brexit, Ukraine, COVID, but investment, is a long-term issue. I think we've been very weak in terms of our investment behavior for many, many years. And I think that's down to policies, but no doubt we'll come back to that later. The labour market is obviously, very important to all of us. And at the moment, we are at full employment. I don't expect to see a fall in unemployment from 3.7%. In my lifetime, it's never been lower than that. If it goes another 0.1 down, that would be great news, but it's not going to be sustained. However, with the economy slowing down this year, we are expecting to see unemployment rise this year and perhaps into next year, because we're not going to see any significant growth for the next couple of years, as I said earlier. For now, however, the big story is labour shortages, and many of you will know this, across many sectors. We have vacancies at a record high, and they are beginning to fall, which is not good news, because it means that companies are not advertising as many jobs as they did previously, but it's still very high. The employment rate is 75.6%. And as you all are well aware, there's been a great resignation and a great retirement problem. And we've now got employment rates still below the pre-pandemic levels. Now, what that means is if and when the economy does start to increase in terms of activity, we've got a limited capacity to satisfy demand. We have a labour shortage. And of course, this is what's driving some of the inflationary pressure, but only slightly. Inflation today is, in my opinion, is primarily determined externally. It's due to global food prices, energy prices, supply chains, etc. But some inflationary pressure is coming from wages, and that's what the government is most concerned about. Hence, some of the deals that have been done recently, below inflation deals, will take a little bit of the pressure off the wage price spiral. But we have got a problem in terms of our labour market right now, as well documented and well publicised in the media. This is the figure I mentioned, the job vacancies, and you'll notice the latest figures just show the number of job vacancies coming down again from the peak that we had. So at the moment, it's about 1.1 million. And people often say to me, well, Joe, if there's that many jobs available, why can't all the unemployed get these jobs? Well, of course, there is a skills mismatch. There's a geographical mismatch. This is not simply a case of one for one. This is going to continue as a problem, I think, for several years into the future in terms of this mismatch and labour shortage problem. And here are the latest figures from the OBR. Again, you'll see in November, they had their forecast was unemployment rising towards 5% by 2024, 2025. And I did say earlier, the economic outlook has slightly improved. And remember, improved means not as bad as they thought it was going to be. It doesn't mean it's going to be a fantastic outlook. As a result of that, the forecast for unemployment, you see it going up, but not as high as was expected just a few months ago. And you'll see it going up perhaps to about towards 4.5%, and then coming back down towards 4.2% approximately. But let's put this in perspective. These unemployment figures are actually very good. The UK has done, the government has done a very good job in keeping unemployment lower than many economists, including myself, expected. During and post COVID. So this looks a little bit worrying, but actually, in context, it's actually very, very good. Participation rates I mentioned earlier. This is the OECD have produced very, very recent figures comparing different countries. You note on the left-hand side, you'll see the UK there in yellow. Our participation rates are, comparable to Germany, Canada, Japan, and better than USA, France, and Italy, just to give it a perspective. But the right-hand side is the important bit. And it's the topic that the Chancellor was focusing on last week. UK participation since the pandemic. If we go pre-pandemic and then since then, we have had a real problem. Participation rates have fallen relative to, many other countries. The USA has also fallen, but we have the biggest drop, as you can see very clearly there. And that is a worry for this country. And it's, as I said earlier, it's the one that the Chancellor is trying to reverse with a number of the tax measures, which we'll discuss later. So we had the Great Resignation, we had the Great Retirement, and we got long COVID issues. There are many elements here to try and explain this, but what we do about it is the big question going forward. Turning now to government finances. I want you to focus on this slide, and some of you may have forgotten just how cheap money was only a year or two ago. If you look very carefully at the bottom of this, this shows, by the way, 10-year government bond yields. And 10-year government bond yields represents the base. It's the cost of capital, the cost of long-term funds. So if you're a AAA rated company, you'll be borrowing money at approximately 10-year government bond yields. If you've got a fixed rate mortgage, it'll be linked to 10-year government bond yields. And of course, the government's own borrowing is obviously directly affected by 10-year government bond yields. You'll see the figure on the right-hand side for last Friday on March the 17th. I just checked the latest figure this morning. Well, I checked it before 8 o'clock, so it was yesterday's figure. It's now 3.369. Haven't checked after 8 o'clock this morning, but it's roughly around about 3.3%. So bond yields today are significantly higher than they were at the very low point. You'll see at the bottom of this slide, by the way, at one point they were down to 0.07, almost zero, 0.07 at the very bottom of the graph. So long-term bond yields have gone up significantly. And I just mentioned that has implications for the cost of government borrowing. So more of our hard-earned taxes are being used to fund government borrowing. Fixed rate mortgages, of course, have gone up, as we're all well aware of. But most importantly for us here this morning, the cost of corporate borrowing has gone up as a result. If you look very, very carefully, you'll notice the effect of the September mini budgets, September the 23rd. You see the spike that went up as a result of that mini budget. And then, of course, we had the reversal on October the 17th, and then the fall in bond yields. But nevertheless, bond yields are still higher, even allowing for the after effects of this. This is true across the world, by the way. This is not just unique to the UK, where we have relied on very, very cheap money for a very long time. We're now getting back to something more normal, whatever that means, by the way. I mean, normal is the new normal is now what we're finding today is like, what's new anymore. Now, a bit more on public sector finances. These are the net borrowing figures, percentage of GDP being borrowed each year. You'll notice that the spike, of course, during COVID there, where the public sector net borrowing went up to about 15%. And then you'll notice to the right-hand side in the forecast shaded area, we had the figures again for forecast last March, the green. Then they were revised in November, the yellow. And then we have the dotted line pre-March 2023 forecast. And then we have the March 2023 forecast, the OBR forecast made at the time of the budget. And again, you'll see that this is in line with what the government has stated. They are planning on a reduced budget deficit year by year by year, right up to 2027, 2028. So what they're trying to do is add less and less borrowing to the mountain of debt that's outstanding. In other words, the gross public debt, the net public debt, gross and net, because if we exclude the bank borrowing as well. So here's a bit of history going back to 1921. Don't look at too much detail here. Just here's the latest figures for December 2022. And just the point being made here is our total public sector net debt, the total, that's the outstanding debt, is the highest since we've had since the 1960s. If you look at the dotted line going from right to left, it's the highest since the 1960s. We've had decades of relatively low public sector debt. You'll see down there back in the 1990s and then into the noughties. But then along comes the financial crisis and debt starts to rise again. And then along comes COVID. Again, nothing wrong with debt. The point I mentioned earlier was it's the cost of servicing that debt that's really important. And bond yields have gone up. Now, if we take that bit of data and now go to the more recent years, again, OBR forecasts, and you'll have heard the Chancellor mention this. Let's just focus on the March 2023 forecast, the blue line to the right. And you'll notice, by the way, by 2027, 2028, the total public sector net debt begins to slightly track down. The Chancellor, as I said earlier, is trying very hard not to add to the total volume, a total value of debt. But it's going to take several years before it stops rising. And it's just until 2027, 2028 that we begin to see a slight downturn. So this is what we're going to... this is what our children are going to inherit, by the way, this huge debt. It won't quite get to, it won't get to 100% based on the current plans by the government. That brings me neatly to monetary policy. So we dealt with the government and the finances, that's fiscal policy. And now monetary policy, of course, is the Bank of England. And, you know, credit where credit is due. The Bank of England did a great job in supporting recovery from COVID. You remember quantitative easing? The effect of that was to push down bond yields to those record lows I mentioned just a moment or so ago, and record low short-term interest rates. The base rate down as low as 0.1%. So we have lived, well, I was going to say we've enjoyed in some extent cheap money, both long-term funds and short-term money for quite a few years. But that's over now. We now have what's called quantitative tightening. I've not used that phrase before. Quantitative tightening began on November the 1st. The UK was the first of the G7 countries to start selling off its bond holdings. In other words, central banks, they bought bonds and drove down bond yields. Now they're selling back bonds, which of course pushes bond yields upwards. The Bank of England was the first to start doing this. But look at the numbers very carefully. They've only sold a very small value of bonds, 750 million bonds out of a total holding of 838 billion. So this is just testing the water. The bonds that have been sold at a loss because they bought them at a certain price. Now they're selling them back at a lower price, and the losses are being covered by the Treasury. So another problem for the Chancellor in covering these losses. So they clearly don't want these bonds to be sold back too quickly. Otherwise, there would be a significant loss to deal with later. Short-term interest rates, they've risen now 10 times since December 2021. And indeed, we're now waiting for tomorrow's MPC, Monetary Policy Committee, to meet. Another rise is expected. I've got an exclamation mark there. Expected, but is it necessary is really the question maybe we'll come back to. My personal view is I think that the Monetary Policy Committee should wait and see whether or not inflation does track down in the coming months. I know inflation has gone up today, but I think in the next 3 to 4 months, we're going to see significant falls in inflation. But we have seen a record low of 0.1% up to 4% on the 2nd of February. And we're now at the highest rate for 15 years. But, you know, let's show some sympathy, please, for the Bank of England. I think they've got an incredibly difficult job to do at the moment. This is a balancing act between getting inflation down to its 2% target versus, you know, the economy. Any rise in interest rates is going to stifle economic recovery to some extent with a time lag. Very difficult to hit 2 targets with one bullet, and they've only got one bullet, and that is interest rates, of course. Inflation's at a very close to a 40-year high. So it's the high was actually last October. I'll come back to that in a moment, but it's very close to that still. But there are signs that inflation has peaked, despite this morning's figures. This morning's figures were primarily due to the fact that we had the bad weather in Spain, and food prices went up sharply from January to February. But that effect will drop out very quickly in the coming months. Here's the forecast from the Bank of England and the OBR's forecast based on Bank of England data about the path of base rate, the bank rate. Again, just focusing on the March 2023 forecast, you'll see here that the blue line. They're expecting it to peak. This is the OBR's forecast. They expect it to peak at about 4.25%. So in other words, they're factoring in, I guess, a rise tomorrow. And then they expect it to fall slowly thereafter until 2027, 2028. So in the next 5 years, base rates expected to head down towards 3%. Now, forecasting that far into the future is clearly an inexact science, but it's a basis for planning. But I wouldn't put my life savings on it either. There are so many events that could upset this. And in terms of QE, by the way, just to remind you of the scale of the purchases, the bond purchases by the Bank of England, the bottom column here shows 895 billion. They only got to 838 billion, by the way. They didn't borrow as much as they expected. But it all began, if you remember, in 2009, the financial crisis. They bought $200 billion or pounds worth of bonds. They didn't sell them back again. Then they bought more, which increased the bond holdings to 375 billion because of the Eurozone debt crisis, and they didn't sell them back again. And then they bought more bonds to support the markets during the Brexit referendum, took it to 445 billion. And then, of course, the pandemic. So the total bond holdings were planned to reach 895 billion. But thank goodness the pandemic has now passed, and they didn't borrow as much as they had planned. But nevertheless, a lot of bonds being held by the Bank of England, which is unusual. And they do want to get these off their balance sheets, but they don't want to dump them onto the market too quickly, as I said earlier. Now, inflation. I think it's a great quote from Ronald Reagan. It's a famous one that economists often use. Inflation is as violent as a mugger, as frightening as an armed robber, and as deadly as a hitman. Central banks hate inflation. That is their primary target, to control inflation. Now, I'm going to give you a bit of an Econ 101 lesson just for a moment. What caused inflation could be due to many different factors. Inflation can be caused by what's called demand pull. In other words, governments can cause inflation. Government spending and low taxes can stimulate overall spending. So fiscal policy can cause inflation. Monetary policy can cause inflation if money is very cheap and we borrow and spend. And if the money supply, i.e. quantitative easing, pumps liquidity into the economy. So that policy can cause inflation. But also, of course, domestic factors can cause inflation. This is called cost push due to wages. And that's the fear that the government has about a wage price spiral. But inflation can also be caused by external factors, international factors, again, pushing up costs, and primarily due to oil and energy prices and international food prices, hint, hint. And finally, of course, the expectations-induced inflation. If we expect prices to rise tomorrow, we tend to go out and buy today, and that itself causes prices to rise. So central banks are always very keen to reduce expectations of inflation. That's why they set inflation targets. Big question is, what's causing UK inflation today and what's going to happen in the future? Our inflation, I said earlier, has primarily been caused by the international factors in the last year or so. The Ukraine war pushing up energy prices and oil prices and food prices, the supply chain bottlenecks, during and post-pandemic. We're now beginning to see some inflation, of course, come through from wages, but not a lot. And of course, the government's support programs, the big, fiscal packages that were implemented to help companies and help all of us, by the way, through the pandemic and through this energy crisis, that money has been pumped into the economy, and we've relied on cheap money as well. So there are some domestic factors here that have caused inflation, but I think a significant proportion of inflation today is due to international factors, and therefore my view is that the Bank of England should pause any further increase in interest rates. I don't think they will, but my suggestion is they should. And so here are the latest, well, not the latest figures. I couldn't update these before our session this morning. The February figure is now 10.4%, and you'll notice that the peak was 11.1% last October, as I just said a moment ago. But what's going to happen after this? Now, the OBR very helpfully have produced forecasts for inflation as well. This doesn't guarantee that inflation will fall, but there are a number of reasons why we are very confident that inflation will fall sharply from the middle of this year. There are at least three reasons. We're not expecting energy prices to keep on rising so quickly. As we head into spring and into the summer, the demand for energy in Europe falls significantly, and that therefore tends to push down wholesale prices. We've already seen wholesale gas prices are now below where they were before the Ukraine war. So that will feed through to retail prices in the coming months, around about July time. Import prices will also moderate because supply chain bottlenecks are easing up around the world. Those microchips that have caused such a problem in the car industry are now beginning to ease up as well. And thirdly, of course, and sadly, as the economy slows down, that's going to take some demand out of the economy, and that will reduce the pressure on prices as well. But there's two external factors here and one internal factor, and all of these. Well, the third one is unfortunate, but they're all going in the direction of making sure inflation will track down in the coming months. But we just got to be careful. There are events that can happen that could disrupt these expectations. I don't want to make predictions about wars and pandemics of what might happen in the future, but there is always a need to be wary. So the OBR forecasts make for interesting reading. You'll see the figures again going back to the November forecast made in November. They even had inflation going into negative, in other words, deflation in 2025, 2026. But now they've revised those figures, and you'll see that the blue line in the forecast area, the March 2023 forecast, the OBR does see inflation drop significantly this year and the following year. And into 2025, 2026, inflation is going to get, well, around about zero before it gets back on track by 2028, back up to the 2% target. Now, what that signifies to an economist is the economy is going to go through some difficult time periods for the next few years. The economy is going to be very slow to recover. Demand is going to fall. Unemployment is going to rise to some extent. The government's going to squeeze their own spending. They're going to squeeze their own borrowing, and this is going to slow the economy down, sadly. And the consequence will be inflation will fall. But it's good to see inflation coming down, but it doesn't feel like good enough. It's the reasons for it which are concerning. But inflation will go down sharply. The government and the OBR are both forecasting 2.9% by the end of 2023. A number of economists are predicting that's rather optimistic, but I'm not going to argue too much about this. Whether it's 2.9 or 3 or 3.5, it's going to be a lot lower than it is at the moment. That's the important point. So I'm conscious of time, and I want to make sure I finish on schedule. The consumer, that's you and me, by the way, in every country, we are king in the sense that we account for the biggest proportion of all spending. In the UK, consumer accounts for about 60% of all spending. USA is higher. But we are facing a number of crises, and there's no surprise here. The cost of living crisis affecting millions of households across the country, and the energy price crisis is still ongoing. Of course, we should thank the government for the energy price guarantee, which has helped to suppress headline inflation. And they have announced that they're going to continue support until the end of June 2023. They've extended another 3 months, as you will have heard during the budget. But still, it's a lot higher. The prices are still a lot higher than they were before the Ukraine war. And consumers, not surprisingly, remain very concerned. This is affecting millions of households across the country. We've heard this morning, food price inflation is now again at a record high once more. I mentioned earlier the cause of the food price inflation in the latest month has been largely due to the bad weather in Spain, which has driven up a number of products and other factors you will no doubt hear about later today. And therefore, the consequence is that real wage stagnation has taken place across the economy. And we've got this gap opening up between private sector settlements and the public sector settlements. And again, that's causing a number of, strikes to take place, as we're well aware of. Consumer confidence is historically low. I want to emphasize this. It's an important point. And just to remind, I'll come back to it in a moment, but in terms of inflation, again, this will be slightly updated. Alcohol and tobacco prices went up sharply. So all the discounting of alcohol has reversed. And so we'll see a bigger figure of alcohol inflation. I mentioned already food price inflation, but this is the figures for January. We haven't yet got the figures. They only come out this morning at 8 o'clock. for February, but the picture will be very, very similar. Significantly higher prices for many, many people across the economy. Now, critical point here, the ONS have produced this graph just a week or so ago. If you take the trend line based on the 2008 figures, you'll notice the blue and the trend going together here, and then take the trend line right up till the present day, and then the blue line shows actual weekly wages in real terms, in other words, allowing for inflation. The ONS, the official statistical office of this country, now estimate that relative to what they would have expected in 2008, what they would have expected today, real wages are nearly £600 per week lower than expected by the ONS. It is a significant reduction, by the way, from the trend line and the actual line. Again, these are the official figures based on the December 2022 prices, in other words, relative to inflation. This represents 15 weeks of real wage stagnation, and that's what is hurting a lot of people across the country. Again, the OBR have produced a very interesting and worrying graph, by the way. Their view is that in the next 2 years, again, you'll see that on the right-hand side that the two red columns, histogram below the line, they have estimated that living standards will not recover to pre-pandemic levels until 2027. Again, these are not my figures. These are the OBR's independent figures. All of the historical data is from the ONS, the official data, and then the OBR did an independent forecast, which was used by the Chancellor. So we are going to see a tough time ahead, or continuing tough time ahead for many, many, many people. Now, you'll all be wondering about mortgage rates, no doubt, and house prices. And the left-hand graph shows you again the figures for November, the forecast made in November 2022. And again, the mortgage rates then were forecast to reach about 5%, the fixed rate mortgages. Those forecasts have come down significantly. But still, even by 2027, 2028, fixed rate mortgages are going to be probably around just over 4%. Now, if you look to the right-hand side, oops, excuse me, I should go back there. Look to the right-hand side, not surprisingly, house price inflation, or house prices actually, house prices are expected to fall over the next 2 years. They've already started to come off the boil already. The conditions in the housing market, conditions in the mortgage market, conditions in the economy, all point to lower house prices. In other words, negative house price inflation for the next couple of years. And we're seeing a recovery after that. But by 2028, they'll be back to where they were by 2023. You'll see a 5-year period there in the forecast period. So it's going to be a bit of a dip in house prices, which is not surprising given the economic situation. So in summary, on my last slide, the state of the economy, very quickly, a growth recession is inevitable. Let me define that. A growth recession means growth below trend. That's the figure, that's the comment that the Chancellor should have made last week. We are not going to grow back on our long-term trend for several years ahead. Growth recession is a phrase that was coined during the global financial crises. We'll still grow at some point. Of course we will. But it's going to be disappointing relative to our long-term trend, which is about 2.5%. We're not going to get back to that for a number of years. The slower trend growth, therefore, thereafter. Unemployment is historically low, but the problem is we've now got labour shortages across the economy. We still have high job vacancies, but they've come off the boil as well. And of course, as I've said, and we're well aware of this, there's real wage stagnation for many. In other words, the rise in wages is less than the rise in prices. And therefore, real wages are falling for many, many people. Unemployment is going to rise, but not as high as was previously forecast. But still, there will be some problems. Big challenge for the UK, I said at the beginning, and for many countries, by the way, is low productivity and low investment. And across the country, we're getting a lot of regional disparities as well. Hence the idea of levelling up. We desperately need to get investment moving up to the northern parts as well, which have suffered from this. Inflation, 40-year high, but I'm going to use the word plummet. We are going to see some significant falls. It didn't happen today, again, for the reasons I mentioned earlier, the food prices and the bad weather in Spain. But we will see some sharp falls in the coming months. And if I'm wrong, well, I'll be wrong. But it's all the evidence is very, very strong. Food price inflation at a 40-year high, of course, I mentioned earlier. And the national debt won't quite get to 100%. But bond yields, of course, have risen. I think we're probably near the peak of bond yields. I said around about 3.3%. It's possible they could go higher, but I think that's the market's factoring in about that figure. So long-term borrowing yields. And of course, short-term interest rates, they're near a peak, and we wait to see what happens tomorrow. I'm hoping they won't rise tomorrow, but I expect they will go up by 0.25%, unfortunately. And the cost of living crisis is here to stay for quite some time, sadly, for many, many people. And we'll hear about the tax changes as well, which won't help. And of course, record low consumer confidence has been a factor. So my last point is, not surprisingly, challenging times ahead. I hope that doesn't sound too sarcastic. It's meant to be a warning for all of us that we face tough times. So on that point, I hand over to my colleagues and we deal with personal tax.
Thank you, Joe. Looks like a difficult couple of years ahead, and in particular your slide about disposable incomes over the next 2 years falling quite dramatically was striking, and that's really sort of focus of my first couple of slides, because I wonder how much of that can be attributed to the increasing tax burden. So in relation to personal tax, there wasn't really many significant announcements in last week's budget, but we mustn't forget the measures announced previously that reduce or freeze many of the allowances. And if Joe just kindly move on to the next slide, it will sort of list the things I want to just briefly cover. So these are the changes or the thresholds that are being frozen from April this year. Firstly, the capital gains tax annual exemption is reducing down from £12,300 in the current year to £6,000 from April and £3,000 from the following April. Similarly, the dividend allowance, that's the amount of dividend income that you can receive without paying income tax, is reducing from £2,000 per annum at the moment to £1,000 from April for the next tax year, and £500 going forward from April 2024. Now, on their own, these two measures perhaps don't seem particularly significant, but they're set to yield in the region of £1.5 billion additional tax revenues per annum by 2027-28. From a planning perspective, in particular, there's perhaps an opportunity in the next few weeks with the capital gains tax annual exemptions. If you're sitting on capital gains, you have an opportunity to use or utilise that larger exemption. And if you and your spouse, for example, have an investment portfolio sitting on gains, you can have one spouse sell and the other spouse reacquire the investment just to crystallise and use up your CGT annual exemption. The third point there is that the additional rate threshold for income tax, that's the threshold above which individuals pay income or start paying income tax at the highest rate of 45%, will reduce down to 125,000 from 150,000 in April this year, which will bring something in the region of 500,000 people into that highest rate of tax. So one sort of point that strikes me here, particularly in a world of higher inflation, is that if that 150k threshold for the additional rate had risen in line with inflation since 2010 when it was introduced, it would now stand at around 212,000. But of course, it hasn't moved at all in that time, and it's now coming down. The final couple of bullet points on the slide here just confirm that the main income tax and NIC thresholds are being frozen right through to April 2028. And that includes the employer's NIC threshold as well. So all these measures will create a fiscal drag, whereby inflation and earnings growth will push more people into higher tax brackets and significantly increase the tax burden and ultimately reduce real incomes. And if you can just flick over to the next slide, Joe, I've kind of looked at a situation where there's the fall in real incomes can be particularly noticeable. So take a situation where, as I've set out here, a single parent household with income of 50,000, that's employment income, and an entitlement to child benefit for that one child. Now, currently, that individual's marginal rate of tax is 20% in terms of income tax and 12% NIC. So let's say their highest rate of tax or highest effective rate of tax is 32% on their income at the moment. If they get a £5,000 pay rise this year, so an inflationary 10% pay rise, because of the freezing of the higher rate threshold, that £5,000 is subject to income tax at 40% and the higher 2% rate of NIC. They also have a clawback of half of their child benefit, which actually, if you add all that up, that means the total tax burden on the £5,000 increase is 54% or £2,697. So that gives them an extra £191 per calendar month. And if Joe just flicks over to the next slide, if you look at what their income or monthly income would have been had it risen simply in line with inflation, so if their net income after tax had risen in line with inflation, it would be £3,409 per month compared to what they will actually receive now because of that increasing tax burden of £3,291. So in summary, that individual on relatively modest income will see a real decrease in after-tax income of £118 per calendar month, or £1,400 a year from April this year. Right, my final slide looks at probably the most significant, certainly the most costly personal tax measure announced in last week's budget, and that's the changes to the pension allowances. So from April, the annual allowance, that's the maximum tax relief pension contributions that an individual can make without incurring an income tax charge, will increase from £40,000 per annum to £60,000 per annum. Also, the minimum tapered annual allowance and the money purchase annual allowance, and I'll explain these in a second, will increase from £4,000 to £10,000 per annum. Now, the money purchase annual allowance applies where someone has already flexibly accessed their defined contribution pension. So really it's there to stop people getting maximum benefit from recycling money out of and into pensions. The tapered annual allowance applies where someone's adjusted income exceeds £240,000 per annum, with the annual allowance above that being reduced by £1 for every £2 of income that exceeds that threshold. Now that threshold is also increasing to £260,000 from April. So that minimum allowance or minimum annual allowance of £10,000 will now apply to those with those incomes in excess of £360,000 per annum, whereas currently a minimum allowance of £4,000 applies to those with incomes of £312,000. So there's quite a very large increase in the scope for pension contributions. And of course, as has widely been discussed, these measures were introduced to encourage highly skilled workers, primarily NHS doctors, for example, to return and remain in the workforce. Of course, it remains to be seen how effective they will be. Probably the most surprising measure in terms of pensions, though, was the complete abolition of the lifetime allowance, which is the total amount that someone can save in their pension without incurring a tax charge. Now that charge is up to 55% on the excess when someone reaches age 75 or when they access their pension if earlier. Arguably, you might say this was unnecessary, and certainly it was unexpected. But I've speculated since last week that perhaps this might be something to pave the way to bring large uncrystallised pensions within the charge to inheritance tax, perhaps. Currently, they sit outside someone's estate and it could be used as a really good inheritance tax planning tool. In the meantime, though, the increase in the annual allowance and the abolition of the lifetime allowance does bring pension contributions back to the table as a planning tool for some clients for the first time in many, many years. And my final point before handing over to Tony is that also in regards to pensions, the entitlement to a 25% tax-free lump sum has been capped at 268,750, which is 25% of the current lifetime allowance. Now, if this is not subsequently increased in line with inflation, that of course means that the value of the tax-free amount will gradually erode over time. And this is something that has been speculated for many, many years might be open to attack or reduction. And on that note, I'll hand over to Tony to finish up.
Thanks, James. I'm going to just talk about corporate taxes and any changes that happened in the budget. Next slide, please, Joe. So what do we already know? Previous announcements, we talked about what the rates were going to change in this budget. There was some discussion about associated companies and bringing back the old rules about companies that will change the rate of tax payable by certain companies. Changes to the R&D tax relief, and finally the big announcement that was the capital allowances change in the end of super deduction that was in until the end of March. So what's new? Well, we do have new capital allowances regime, which I'll touch on later, which is a new unlimited first year allowance and full expensing for companies. We have an enhanced tax credit for R&D intensive companies, albeit when I explain it, it's probably just staying at the same level. And then there was some comments about investment zones. So as it was well touted, and obviously there was a lot of political to and fro in and arguing about whether the rise was right to do, but the Chancellor introduced the rise from 19% to 25% from the 1st of April this year. For those companies, standalone company, for example, that has a profit of below 50,000, well, those rates are going to remain at 19. But then what happens is we bring back in the tried and tested marginal relief regime, where an actual higher rate of marginal tax is applied between the rates of profits of 50,000 and 250,000 to bring the full rate up to 25%. That marginal rate is 26.5%. So what we do have is a situation where companies are, in that bracket will actually suffer a much higher marginal rate of tax than even the headline of 25. But what is going to be brought in is to go back to the old rules about associated companies. So we had a number of years when the corporation tax rate was unified to 19% for all companies. These rules were taken away. However, they've now been brought back in from the 1st of April. And effectively, what it's to talk about is all accounting periods ending after or straddling 31st of March 2023. You have to think about not only companies within a group, but also associated companies. In that, effectively, any associated company within the previous 12 months that is either controlled by another company or both controls or under the control of the same person or persons. And what we do bring back in is who are those persons, connected persons, i.e. relatives of individuals controlling companies, will be considered where there is commercial interdependence between non-group companies. So a lot more focus will be upon individual companies and their shareholdings and their interaction with other related companies. The effect of this will be twofold. One, the number of associated companies will reduce the limits in which the higher rates of corporate tax apply. So, for example, I said before it was 250,000 was the full rate for a single company. If there are two associated companies, that will be halved to 125. So you can see that it doesn't take many connected companies to reduce the the relevant thresholds, and therefore effectively put most companies within the 25% charge. It not only increases the rate of tax that will be paid, but it also brings into a point about the actual timing of payments of tax as well. So the quarterly instalment option that's available, well, not available, but actually enforced upon companies to pay, will also be affected by the number of associated companies. So I think what we will see is a significant increase in the number of companies that are not only required to pay a higher rate, but also to actually start paying their tax during the year rather than the normal 9 months after the year end. Next slide, please, Joe. So then just talking about research and development, a little bit sleight of hand, this one, in that it was actually trumpeted as though it was an improvement, but I think this follows on from comments in the previous budget where HMRC, whilst they might say outwardly that they're trying to encourage R&D, have been concerned about the level of R&D claims and actually whether some of those are spurious or not quite as they should be. So I think what they're trying to do is actually pare it back a little bit. So you can see here from the 1st of April 2023, SMEs, the actual additional deduction rate will be reduced from 130% of any expenditure to 86%. The large RDEC credit rate will actually increase for larger companies, so that's welcome. However, as a consequence of those reductions, the SME repayable tax credit for any losses that are generated by R&D will reduce from 14.5% to 10%, thus effectively reducing the tax benefit of R&D expenditure. They will be extending the scope of R&D to include data and iCloud computer costs as well. The important point, just touching upon HMRC's view of recent R&D claims, is that there will now be a new requirement to notify HMRC in advance of making a claim. They'll be required to make it digitally, and claims to include narrative content, provide details of the agent who prepared the claim, and for the claims, importantly, to be endorsed by a named senior officer of the company. HMRC have hired additional inspectors to review R&D claims. In the early days, R&D used to have a number of hubs with HMRC. They seem to row back from that in the later years, and I think probably will go back to that. So the hiring of inspectors might not just be viewed as a bad thing in that there'll be more scrutiny. However, I think what we will find is there more assistance from inspectors as to what are reasonable and correct claims. And HMRC, as I said, will intend to crack down on errors and fraudulent claims. So we'll probably expect to see an increase in R&D inquiries. And therefore, as I say, restricting relief for inspective R&D conducted overseas, that's something that's been reviewed and has actually been delayed until next year. So turning to the next slide, please, Joe.
It was.
Thank you. So increased tax credit for R&D intensive SMEs. Yeah, an SME definition is pretty large in that they have 500, less than 500 employees, 100 million turnover or 86 million gross assets. What this enhancement is for those qualifying companies that actually spend at least 40% of their total expenditure on R&D, and if they are loss making in a year of claim. What this particular announcement said that those particular R&D companies, well, their tax credit is then going to go back up to 14.5%, which is the credit that everybody else enjoyed. So it was seen as an enhancement, but actually is just providing R&D intensive companies with the same relief that previously was available in that instance, certainly on the credit side. So the benefit to a company in this bracket would be a £270 benefit for every £1,000, as you can see from the calculation there, and that £1,000 will be enhanced by 186%, and they will receive a 14.5% credit from that. And that's compared to a normal non-R&D intensive company where they will only get £186. Most companies undertaking R&D will probably not qualify for this, and this will be mainly for new startup businesses and blue sky R&D companies. So touching finally on capital allowances, again, I think the point about corporation tax increasing to 25%, the government have been keen to say that a number of businesses will not actually pay the full rate because they will hopefully invest in plant and their businesses. I mean, this touches on what Joe says, that investment in the UK has been particularly poor for the last 10 years, and the super deduction introductions that were introduced 2 years ago that will finish on 31st of March have then been further enhanced by further reliefs available to businesses for capital allowances. So the idea is that that rate of 25% will be severely curtailed if you continue to invest in plant and equipment. So what is it? The annual investment allowance, which is an amount that's available for capital intensive investment in plant and equipment, etc. Well, that remains unchanged, and that will be £1 million, and that will be applicable to both companies and unincorporated businesses. And importantly, that is permanently in place. So we have seen a yo-yo of the annual investment allowance over the previous years, but that's a welcome position for many people in business that it's been announced as permanent. The super deduction, as I mentioned before, was a specific 2-year 130% relief for movable plant and a 50% relief for special rate plant, effectively plant that's included within buildings. Well, that was introduced in the 2 years prior to the increase in the corporate tax rate. So that scheme will end on the 31st of March 23. And anybody with a year end of December we'll see that hybrid rate will be 107%, because some of it will be at 130 and some under the new rules of 100. So what is the new rules? This point about full expensing. So super deduction ends on the 31st of March and full expensing comes in. This is effectively an unlimited amount. So anything above the £1 million, you will get 100% allowance for investing in movable plant, and 50% for integral feature plant, so long life assets, solar panels, plant and equipment within buildings. As was with the super deduction, this is for companies only. It will have the same restrictions as the super deduction in that it is only new and unused, and it is not for leasing. So again, this point about trying to boost investment in the UK into new plant. There will be a clawback of allowances effectively where assets are sold. There'll be a balancing charge because of that excessive relief that you've had in the first year of purchase. And the government and the Chancellor said that it's only a 3-year proposal. This obviously would like to improve that, but I think, as Joe alluded to previously, there is not a great lot of fiscal headroom for the government at the moment on their 5-year plans to reduce the percentage of the tax burden to GDP. So I think effectively they'd love to introduce it, but we'll just see whether it will. Investment zones was the final one. Just briefly talking about it, there are 12 investment zones, as you can see, in various regions around the country and in Scotland, Wales and Northern Ireland. There will be special tax sites connected with investment zones. There's going to be a 5-year incentive matched to the free port proposals, and those incentives will be effectively enhanced capital allowances available for the construction of buildings within those zones. So there'll be a 10% tax deduction for the construction of such buildings. There's mooted to be relief for employers' national insurance, relief for stamp duty, land tax on the acquisition of land and buildings, and finally business rates relief. So those were a quick firefight summary of what went on, and obviously I think now we're probably open up to questions.
Yes, thank you, Tony. Just as a final point, just thought I'd mention for the benefit of the audience that we've deliberately not covered measures or tax measures that apply only to multinational corporates operating in the UK, but there's quite a lot happening in that space. So in terms of global minimum tax, for example, at 15%, and the changes to transfer pricing documentation requirements for multinational groups. Again, that we're conscious that may or may not be relevant for everyone in the audience, but certainly it's keeping our complex and multinational corporate team busy. So if anyone does need advice in that space, please do get in touch, and my colleagues will be happy to help. And on that note, and after that plug, shall we get on with a few questions? And I think we've got a few that have arrived in the Q&A section. Please keep them coming if you have any. I saw there was one for me that perhaps I'll deal with first. So Brandon asks, can a person who has claimed the lifetime allowance on the pension, I think that means that kind of person who's got lifetime allowance protection, but has received the 25% tax-free lump sum, now make further contributions into their pension? Simple answer, I think, actually is yes, because the money purchase annual allowance will not apply, or should not apply, where the only money you've taken from your pension is the tax-free lump sum. In order for the money purchase annual allowance to apply, you'd have to access your pension flexibly, broadly. So yes, in answer to your question, obviously happy to talk about your specific circumstances separately. I think there will be a lot of people considering this going forward. First question for Joe. What will happen to mortgage rates over the remainder of this decade?
Well, who knows is the answer. But I think mortgage rates have probably not yet peaked. There may be a slight increase, but if you look at the bond yields as a benchmark, I think they're close to the peak, and probably we're going to see them head down towards maybe 3%. But forecasting to the end of the decade on mortgage rates is an inexact science. I do not expect to see them galloping up, and I do not expect to see them falling dramatically. So I think we're really in that sort of Goldilocks situation where they're not going to go up too much nor down too much. I would say they're close to where they're going to stay for quite some time.
Thanks, Joe. Next question. Do you think the economy and investment would improve under a Labour government?
No, I'm not a politician, but I think under a Labour government, what we will see is a lot more spending on infrastructure, which, obviously this government wants to achieve. But I think, we're going to see a big increase, I suspect, in a lot of the the more regional projects around the country. The reason why I'm hesitating slightly is debt is already very high. So we desperately need to see growth coming through to fund this. So under a Labour government, they'd like to spend more. I'm sure of that. Will they be able to spend more is the $64,000 question. I think it's going to be, as I said earlier, I think it'll be some time before we see a healthier economic climate that makes it possible even for a Labour government to borrow more and spend more. But they'd like to. Whether they can or not remains to be seen.
I think just on tax as well, really. I mean, I suppose the announcements that have just been announced in the increase in the rate, but actually a lot of relief for business investment, probably is closer to the centre of the political spectrum as well, and therefore nearer to what Labour might do. So again, not being political, but I would not expect significant changes on the business side, really. Certainly in any initial years.
Again, just to repeat my point, we desperately need growth, but growth doesn't happen, overnight. This is going to take a long time, and the basis for growth hasn't really been firmly established. Obviously, we've had the COVID and the Ukraine war to deal with, but this is a long-term problem. This is not a short-term issue.
Next question, Joe, if that's all right.
Sure.
Rapid interest rate rises have impacted the banking sector recently with some high-profile failures. Will rates at or near their peak reduce pressures and provide stability?
Yeah, I mean, let me be very clear. We have not got a banking crisis. We've got a crisis in some banks. And we saw the SVB in America, the technology-focused bank, having some problems. So I don't think we should exaggerate this too much. But obviously, an increase in interest rates does reduce bank lending, does put some pressure on customers. I think, we are near the peak. I don't think we're at the peak just yet, but I hope we are, but I think we'll see that tomorrow. And therefore, any further rise in interest rates will put a little bit of pressure on banks, but not, I don't think it'll create any significant problems for the banking sector per se. So I don't want to play this one up. I want to play this one down. This is not a repeat of 2008, 2009. We have not got a systemic problem in the banking industry.
Thank you. I'm not sure if anyone's going to be able to answer this one, but I'll give it a go. The new investment zones seem strange to exclude some areas in need of investment, such as East Lancashire. Greater Manchester ends around Bury, Bolton, for example, but then exclude Burnley and Blackburn, who arguably are in more need of this assistance. Do you think they'll extend these areas?
Yeah, it's interesting. I mean, I think the announcement in the budget was I suppose the political announcement was to actually announce areas all around the country and in all the regions to say that it was to be broadly, assisting levelling up in some respects. The specifics as where they will be, yeah, I think there'll be a lot of disparity in certain areas as to why certain parts of certain regions are excluded. I think we'll just have to wait and see on that. I think the point is that maybe they might find that if it certainly improves particular areas, that they will extend it to other areas. For example, into Lancashire as opposed to Greater Manchester. But I don't know yet as to why it's not been so much more widely. In some respects, I suppose it's about excluding certain areas then, because you can actually include too many areas, and so I think they're probably just trying to dip the toe in the water, see how it impacts on those.
Thank you. Got a couple more come in. And that person asking the question actually said it might be off topic, but I think we can answer it anyway. Might have to defer to Tony. But is there any change in EV company car relief? I can't recall, Tony. I don't think there is there?
No, that's the same.
And this is probably one for Joe. Where do you see the global equities going in the next 12, 24 months?
I was hoping that wouldn't come to me. If I could forecast equity markets, I wouldn't be sitting here today. Well, I think globally there's still a lot of uncertainty out there. And let's be clear. During the last few years, which have been the most difficult years on record, it has been surprising how strong equity markets have been. But that's primarily due to quantitative easing, pumping liquidity into the economy, and the money's got to go somewhere. Went into equity, went into bond prices, into property prices. So they're all off the boil. But who knows what could happen? I think so much depends on the China, Russia, Ukraine situation. Obviously, I don't see a banking crisis. I said it earlier. But I think it's going to be a bumpy time for the next couple of years. I certainly don't feel very excited about equities at the moment. But of course, on a long-term basis, they will still outperform. I've avoided that one quite well, I think.
Well, you did very well. Yeah. I think we might have run out of questions from the audience. So please, people, we've got 10 minutes or so still on our schedule. So if people have questions, do ask. I mean, from me, I guess, I go back to Joe's slide and comment around investment being the engine of growth, and I know they've mentioned that a few times this morning. And then you see the slide a little further on where we see investment, dipping back again in a couple of years' time. And from a tax perspective, or as a tax advisor, I still remain slightly surprised by the extent of the increase in the headline corporation tax rate, despite all the reliefs that Tony talked about. If you have a view, Joe, what's your view on the appropriateness, if you like, of that headline rate when it comes to encouraging investment into the UK?
Yeah, James, I've been saying this for many years actually. I think we've desperately got to try and get investment growing much stronger in this country, and quite frankly, I think lowering corporate tax would be good news. I think raising it is bad news for investment. It will. I hope it won't drive companies away from the UK, but it certainly won't attract them to the UK. So I feel very strongly about it. you know, and I'll repeat what you just said, but it's an important one to remember. Investment is the engine of growth. And we took our eye off investment for decades in this country. Yes, there's lots of, you know, projects on the go, but if you look at across the economy for a number of years, we should have been investing in energy, in roads, in high-speed rail a lot sooner than we have started to do it. So I think really my point will be very clear. You know, I wouldn't have raised corporate tax to 25%. I know the government is desperate for tax revenue, but actually could have a negative effect. If it slows down the economy, if it slows down investment, then they'll get less revenue than they would have got if they'd left it where it was. Stability is what companies want. Uncertainty is the biggest problem for this country. And of course, you know, we're likely to have a new government in power within 2 years. And who knows what'll happen after that? More uncertainty. So I'd much rather have stability.
I mean, that was evident, wasn't it, Joe, in your slide about the investment, and I think that was the comments about the full expenses of capital allowances on new plant for companies. A 3-year window just effectively accelerates investment now, and then it'll drop off quite significantly once those rates are. So again, that 3-year window just does not provide that long term. Because investment decision by companies is not a snap decision. It's taken over a number of years. So I guess hopefully something might change in the coming budgets to say, well, we might have a bit more headroom and therefore we might be able to introduce it permanently. I think that's probably what business needs and wants.
Now, your point's a good one, Tony. I mean, even on the OBR's forecast, remember, these are the independent forecasts used by the government, used by the Chancellor to plan his strategy. It shows that this increase tapering off after 3 years, which is really bad news. So we desperately need to do something different. And I just repeat my point. Instability is the biggest problem facing investment. As you said, companies, you know, they need a plan, and they need to plan longer term than certainly our political cycle allows.
And we are. Oh no, we have
There's one more.
I think there is one more. Which regions in the world will have the best real growth?
Yeah.
Well, you might have covered that a little bit. Yeah.
It's obviously one for me, James. You know, I think all the data is very, very clear. You know, and this is not a surprise. China is going to continue to forge ahead. I think not only economically, by the way, but politically, as we're seeing in the last couple of days, the balance of economic and political power in the world has been shifting for a couple of decades, but that shift is now beginning to accelerate. I think we are seeing a new world order. And so I do see China moving ahead even more strongly, not as fast as it was growing, but that's okay. It's still going to be faster than any other part of the world. For me, the country that's worth watching is what I call the quiet giant. I think India is one that's well worth watching. If India ever gets its politics into order, I mean, it's rather chaotic politically, but in terms of potential, it has huge potential and is continuing to grow very steadily. So if you move the clock forward, you know, 5-10 years, I think the world is going to continue to reshape towards China and India. Of course, the USA will still be in there as one of the top 3, obviously, but it does leave me scratching my head. Where does this put the UK in the global context? And I think the UK, sadly, in terms of economics, is slipping backwards, and maybe that's inevitable. Politically, we're still very significant. We have got a strong voice, but economically, all of the figures that I'm seeing and all of the forecasts that are out there suggest that our relative position is slipping back economically. But in terms of other parts of the world, I mean, looking further ahead, and I mean the next 20, 30 years, you know, Africa's got tremendous potential, and it's not one country. But Africa accounts for something like 16% of world population, but around about 3% of world GDP. This is what we call the base of the pyramid. The potential for the base to come upwards is immense. And that's primarily the reason why China is investing so heavily in Africa. It sees the long-term future as being very strong there, despite the politics.
Thank you. Right, I'm just checking. I don't think we've had no more questions. So it's 5 to 10. I think we should should probably wrap up. I'll just finish by obviously thanking Joe for another excellent presentation this morning, and my colleague Tony. I believe we'll follow up via email with a link or a copy to the today's presentation and the slides. They'll include our contact details. Please do get in touch if you want to speak to us. And just finish by saying thank you everyone for attending this morning, and I hope you have a good day. Thank you.
Thanks everybody. Thank you.
Thank you. Thank you.